So how do you start investing, especially if you're a beginner? Robo advisors and other novice investors are only a few of the many investment options available to beginners. But where should they begin? The biggest myth about investing is that it's solely for the wealthy, and that you need a lot of money to get started. 10 years ago, this might have been accurate, but not in the 2020s. Technology and industry progress have eliminated every obstacle to access. With all these developments, newcomers have no reason not to invest. Utilize these suggestions to get started. Have you subscribed to our channel yet? Every other day, we upload incredible contents that you don't want to miss. Don't forget to tap the notification bell as well. Now let's start. Number 1. The Investing Golden Rule. You should never lose money, according to the guideline. The investment genius Warren Buffett developed this rule, and by using it, he has earned enormous riches. The simplest method to achieve this is to invest when an option is undervalued at prices that are appealing. By doing this, you will be paying less than the actual cost, which might subsequently help you make a lot of money once things get back to normal. Even while taking chances is wonderful, be sure they are well-considered ones. Avoid investing in the near term because it is quite dangerous. Instead, search for long-term investment opportunities with reliable returns to reduce risks rather than short-term trading. Warren Buffett has acquired his riches through long-term investments. Sure, some people have made fortunes through speculation, but a lot more people have also done the opposite and lost money. Short-term trading involves numerous fees that must be paid, as well as numerous risks that could lead to significant losses. This longer-term trading, which has become more crucial over time, is how many other billionaires made their money. Number 2. Create a portfolio plan. Define your goals at the beginning, including how much money you want to make in the long run. Where in terms of money would you like to be? What kind of wealth would you like to have? Beforehand, ask yourself these kinds of questions, then plan your route. Once that is done, decide which investment opportunities are profitable and whose rate of return would allow you to achieve your financial goals within the specified time frames. When choosing your investments, use this as a reference. Number 3. Trading in papers. Paper trading enables newcomers to gain practical experience without taking financial risks. Using this method, you can trade and invest in stocks, keep track of your gains and losses, and do pretty much everything you would have done in the real world. You can practice your talents for free on a variety of sites now. Consider this as a practice run before you make actual investments. What do you have to lose? In my opinion, how about you start here? Number 4. Shares. One of the finest strategies to invest your money as a beginner can be to purchase stock in a single firm. The method I'm about to demonstrate is the same one that Warren Buffett has employed for the past 60 years to exploit the markets. So how does a beginner investor invest? The right firm and the proper timing are the most crucial considerations. You will need to conduct study on the chosen organizations by examining their management, past performance, and financial statements. Don't make an investment as soon as you find a firm that fits your criteria. Put the business on your watch list for a while. Watch for price drops while you're waiting. Buy once the stock's price drops. Once the corporation reverts to its true value, you'll get a terrific deal and make a profit from this. It's crucial to control your emotions while investing. Recognize that markets may be extremely unpredictable, and even the finest companies can suffer declines. Don't panic or take rash actions as a result of any significant changes. Wait, be patient, and carefully consider the issue instead before making a choice. Never let fear be the motivating force behind a purchase or sale. You'll be in error and doing what the market wants you to do most of the time, if not always. Make sure to stay away from penny stocks when investing. Stocks of companies with a market value of less than $5 are known as penny stocks. Because these stocks are inexpensive, they may be appealing. They are, however, extremely volatile, and there is very little to no information online about the companies. The majority of penny stocks belong to small, newly publicized businesses. So be careful with this. Number 5. Apps for investing. The day has been saved, or rather, novice investors have been saved by technology. There are many investment apps available now that cater to new investors. Some even round up to your credit or debit card purchases and invest the difference in an ETF portfolio. These apps will handle your portfolio and function as robot advisors. There are a ton of apps that will teach you how to invest if you decide to do it yourself. Most have extremely low costs and are practical because you may access them whenever you want on your devices. Number 6. ETFs. Exchange-traded funds or ETFs and index funds are pretty similar. They follow the same investing strategy and follow a certain market index. Compared to mutual funds, these funds frequently have lower fees. The primary distinction between the two is that the ETF are traded throughout the day and have a fluctuating share price, whereas the other has a minimum investment. The minimum investment amount for the ETF is this share price, which may range from less than $100 to as much as $300. They suffer trading expenses in the form of commissions because they are traded every day, just like stocks. They have helped a lot of people financially, but they also call a lot of diligence and investigation. You will need to commit a large amount of time, if not as a full investment, to actually prosper with them. Number 7. Index funds. Mutual funds on autopilot best describes index funds. It beats employing a portfolio manager. Index funds follow an index. An investment index represents a market division. S&P 500 equities represent 500 of America's largest firms. S&P 500 stocks will be bought by the fund to match their performance. The funds track the market index instead of having a portfolio manager, lowering fees. Index funds let you buy a piece of the market like the mutual funds. A few brokerage index funds have no minimum investment amount. Wow, this investment is excellent long-term. Number 8. Life cycle mutual funds. Life cycle funds or target date mutual funds are similar to retirement funds. This option automatically invests for the predicted retirement year. An investor buys a share of a mutual fund to invest in its whole portfolio. Professional managers invest these funds according to a topic. Equity mutual funds buy stocks. Targeted mutual funds often hold bonds and stocks. One can choose a mutual fund labeled to retire in 20 years from your current date. The investor will then take the returns after the term. Number 9. Robo-advisors. These robots developed portfolios and choose investments for people, as the name implies. Robo-advisors can help novice investors. Robo-advisors use algorithms to manage your assets. They charge less than brokers since their systems have less overhead. Robo-advisors cost 0.25% to 0.50%, while personal financial advisors charge 0.5% to 5%. This is a cheap option for newbies. You still need to keep track of your money and what's happening. Some advisors offer instructional content and resources to help you learn about the processes. It's cheaper, easier, and proven to invest. Number 10. 401k Employment Retirement Funds. As a beginner investor, a retirement plan is recommended. If you donate 2% of your salary, your employer may match it with 2%. It's free money that will grow. If you're over 50, you can contribute up to $26,000 to your 401k. You can start with as little as you can afford with this investment plan. Your account will be deducted when you choose a plan. Since most retirement plan deductions are pre-tax, you save more over time. Compounding helps expand your money. Through compounding, a small monthly contribution can grow into a large sum. Overall, follow our brief investing guide and you should be fine. So, when will you start investing? Leave us a comment. We're curious which option do you prefer. Thank you for finishing up this video. Don't forget to like and subscribe. See you again next time.